Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. Welcome to the Market and Turmoil edition of the Long-Term Investing Podcast. We'll try and focus on the long term and less on the market and turmoil, but this is the market that's going on right now today. So thank you for joining us for the podcast. And if you like the Long-Term Investing Podcast with Baskin Wealth, please subscribe to our podcast on Apple, on Spotify, on YouTube. Please give us 5-star reviews. Please comment. We'd love to hear your feedback if you're liking our podcast and anything you think we need to add or drop. Hopefully you don't want us to drop both of our hosts here. But in the meantime, we're recording this on April the 9th, a few weeks after our last podcast. My, oh my, the world has changed, to say the least. I feel every day wake up like we're heading to the slaughterhouse, Ernest, but at some point in time, the market will start to recover and price in, hopefully, all the bad news. Hopefully. So we got a lot to get to today. We're going to talk about the market pullback. We're going to talk about how to play the macro and what we don't do here at Baskin Wealth, which is we don't even try to predict the macro, and a little bit about portfolio diversification. So we'll get right into what everybody, the hot button topic, what everybody's focusing on, of course, is these Trump tariffs, are tit for tat tariffs that started, I guess, Trump unveiled them at the Rose Garden on last Wednesday. It's now today's Wednesday, so a week later, the market has gone down Thursday, Friday, Monday, Tuesday. We'll see what happens today. There's been some pretend rallies, of course. There was a fake news tweet that happened where people thought that Trump might pause some of these tariffs. There was some, I guess, excitement that maybe there's going to be some negotiations, but those haven't held. Those rallies haven't held. So it's been a nasty pullback. Really, Ernest, there's been nowhere to hide. Gold is down, bonds are down, equities are down, obviously, across the board. You name it. Obviously, at the beginning of the year, the U.S. market had done much more poorly than some international markets, but international markets are all down now as well. And so it's a bear market, and in a bear market, it's very tough to find any safe haven. That's why people want to make the pain stop, right? They want to sell all their stocks. They want to just get out, wait till the coast is clear. A, the coast will never be clear, and B, it's so impossible to figure out what to buy, what to sell, when to get out. We've written a couple blogs about it, and I urge you to go to our website and reread them. But I think if you went to our website and went and saw all the archived blogs that we've done, we've probably said this type of same speech a million times because we've suffered through a number of bear markets and pullbacks. So, we're going to stick to our process. We find it very comforting to think and act like business owners when the market is in so much volatility, because really you have nothing to anchor to unless you focus on owning good businesses run by smart management teams that we hope will be selling more of their products and services at better prices and be doing smarter things over the next 3 to 5 years. The next 3 to 5 weeks, anything can happen. Ernest and I are not even going to pretend to tell you what's going to happen. We're hopeful that the crazier this gets, the more this will lead to negotiations and ending some of these tariffs. But of course, some serious damage has been done. So that's my take. That's my 2 cents. Ernest, pass it over to you for your 2 cents. Well, maybe 1 cent now. That 2 cent isn't worth as much.
So the one thing that I think is very easy to get scared by the headlines and and especially the kind of the incompetence with how these tariffs seem to be implemented, including putting tariffs on like an island with penguins on it and those kinds of things.
Yes, or saying to China, well, you're going to do 50%, I'm going to do 100%.
Right, exactly. But I think one thing that is very comforting to me is how companies are not just kind of sitting there like freaking out about all this stuff. So I was reading a conference with the CEO of Foot Locker.
Okay.
We don't own Foot Locker stock.
We don't own Foot Locker. I haven't stepped into a Foot Locker store in a very long time.
And so the question inevitably came up. So, what else would you talk about, right? Like apart from tariffs.
Yeah.
And the CEO of Foot Locker, she said, like we're watching the situation closely, but this is what we're doing with our suppliers. This is how we're navigating. Like maybe we're going to look for ways to cut costs within the stores. Like maybe we'll look for ways to diversify our supply from countries that are less impacted by tariffs. And it's all very, obviously she's like they're reacting to what's happening in almost real time. But they are looking for ways to solve the problem. Like they're not just sitting there saying like, okay, business is going to zero, we're done, right? And I think that's something that you expect to see across the board, where companies are out there trying to solve whatever problems are being faced to them, whether or not it's like today it's tariffs. Like yesterday, it was inflation and supply chain issues, and that's the job of the CEO to navigate what's happening to the business. So,
so I want to call to action about what we've done in other market pullbacks. This is unfortunately not our first rodeo when it comes to bear markets, corrections, market panics, whatever you want to call them. I started in the business in the summer of 2000, working with David Baskin. That was really the end to the 1990s bull market. As soon as I started working with David, of course, a few months later, we had the dot-com crash, and that was not fun to live with. And then, of course, after that, 2 years of tough markets. Of course, we didn't own any of that crap for clients, but in a bear market, in a tough market, it's really hard for any stocks to do well, of course. So that was my introduction to investing. Unfortunately, I've lived through the 2008 pullbacks and many, many more. Most recent memory is 2020 and 2022. People forget, but we also had a nasty, almost similar, eerily similar type of event in 2018 with Trump's first administration, where the stock market pulled back about 20% in the last 3 months of 2018.
Got no bonus that year.
Yeah, well, that's
I remember it because of that.
Well, you can have all the free coffee you want in the lunchroom. The problem is, right now the market's trading on vibes, so to speak. Right, it's not trading on fundamental values because no one knows how things are going to play out.
Right.
If these tariffs end up being permanent, obviously the market is way too expensive and we could be in for more calamity. If these tariffs are only going to last a few weeks, it's possible the market has overreacted. It's hard to know. But what we want to focus on, and it's very important, is really the long term. And so even during the pandemic pullback, we were thinking about some of our companies had zero business, right? Live Nation, hotel companies, airlines, what have you, cruises. So their focus at that time was like, oh my God, we're going to have zero business. Let's make sure our balance sheet can survive. Yep. And those companies, as long as you can survive the short term and things return to a normal environment, you face some short-term pains, but the recovery is magnificent, right? And so, taking action based upon today's events, expecting that they're going to continue and last indefinitely, to us doesn't make a lot of sense. But, we can't judge other people's actions. It's just for our temperament, for the way we like to invest. We want to think about, okay, we own Apple, we own Google, we own Visa, we own Do we think these are still going to be sustainable, growing businesses in the next 3 to 5 years? Let's let's ignore what's going on at the turmoil right now. That's not at all helpful to the long-term investor. I think, Ernest, you can talk about some of the things that companies did to adapt, even in the pandemic, and that's what we're looking for some of our companies. I think the Foot Locker example is a good one, but an example like in 2020 with Costco, what it did by securing its own vessels, right?
Right.
Yeah,
Yeah.
that's what I'm getting at.
No, I think that's exactly right, which is that, like, on the one hand, if you believe that these tariffs are going to cause the end of US dominance, and that like everything is going to be mass unemployment in the US and a repeat of the Great Depression, then yeah, you probably don't want to own stocks.
Probably not.
But I think barring that scenario, no, things are probably going to be all right in the medium term.
Wow.
And so, and maybe possibly with the result that companies are a little bit more resilient in terms of how they're sourcing products and being cognizant of these kinds of risks in their business.
That's right. So we're assuming that a lot of our companies will come out of this scenario much stronger. Apple reducing its reliance on China and trying to find other suppliers in other countries. Other companies looking to take market share while other companies are having trouble sourcing products, right?
Right.
So in these type of environments, we certainly don't want to increase the risk of our portfolio by buying more leveraged names or small cap names, even if they've been beaten up a lot. We really want to stick with the stalwarts, the blue chip companies that have the ability to add levers, to make changes to their business, to offset a lot of the impact for their customers.
No, and I think that's why when we look for the companies that we want to own, we'll talk a little bit about this topic later, but we generally focus on companies that are a little less at risk to topics like trade or interest rates or big themes potentially, because we think that there is risk in these kinds of things.
Yeah, I see one of the things that Apple did the other day. I don't think it's fake news. They loaded up 5 huge planes with iPhones in China and flew them over to the United States before these tariffs kicked in, right? So giving them enough supply to essentially cover U.S. sales for a number of months, right? So that's why the stock maybe is up today, right? Even though there's tariffs that are going to go through, new products being made, they've already secured the inventory for a fair number of months.
No, we generally look for companies that are more focused on providing services rather than actually making products. Like, yeah, sure, we have Apple and maybe a handful of others, but by and large, like companies that have to deal with manufacturing products, they have to deal with, they have to deal with the cost of products, the cost of making the products. Mm-hmm. They have to deal with like the manufacturers. They have to deal with things like inventory, and generally these are lower return on invested capital businesses, right? Which is why we generally don't look for these kinds of businesses. Like if you look at things like Visa or Moody's or MSCI or Google, right? Like these are very asset-light businesses that are not really directly impacted too much by tariffs.
Yeah, they would be hurt by the knock-on effects, which is probably a slowing economy as a result of uncertainty, and that's probably a fair bet. What's going to happen, of course, to the economic situation in the short term, until there's more certainty, but. The market will never give you that certainty. So, equity investing comes with risks. We say that all the time to our clients. Your portfolio, if you have a high allocation to equities, is high risk. It's not risky because you own bad businesses, but it's risky because of the volatility and the day-to-day price movements. And if you're not prepared to suffer through volatility, then maybe you're not properly wired to own equities. You've all seen it over the years, right? Great companies, share prices falling down 50, 60, 70%. We lived through that in 2022 with Netflix. Stock fell 70+%. and then it recovered, and now it's going down again. But that's the stock market. I urge our clients, urge anybody following our podcast to just focus on the last 3 to 5 years. Look at your portfolio performance. I've said the last 2 years were incredible. You can't go up 30% a year without suffering some pain. And that's probably why the Trump administration is trying at this time, given the markets had done very, very well, given employment was low, unemployment rates were low, given interest rates were reasonable, inflation's coming down. This was the gamble they were trying to take. And we'll only find out in hindsight if it works or not. The natural reaction of every investor is to, our brains say, get me out of this, make the pain stop. And I don't blame people for that. That's how we all react. From the things that I've read, the pain of losing money in the market is as bad as the fear of you being chased or attacked. Your brain reacts in the exact same way, and you want to make it stop. But I urge you to not think about that when it comes to investing. That's probably the worst thing that you can do to your portfolio. And that's why the only anchor we can focus on is, do we own good businesses? Do those businesses generate good cash flows? Will they be selling these products and services even in tough times? Are they going to get disrupted? Are they going to go out of business? And that's really only our worry for those companies. Are they going to go out of business? Is their business model over or disrupted? And we've gone through our companies a number of times. I don't feel any of our businesses are in serious trouble.
No, I think in these kinds of situations, I think what you really want to focus on is the business going to make it to the other side?
Yeah.
And so that's why we've always placed a very, very strong emphasis on balance sheet quality. Yeah. So like looking at how much debt they have relative to like their to equity, right? Like do they generally we prefer businesses that have almost no debt at all, because as we've seen in 2008 and subsequent times, if you have even a little bit of debt and there's a credit event and you're not able to refinance it, like that can really bring the business to its knees.
Of course.
So all the businesses that we own, I can pretty confidently say have extremely strong balance sheets that should allow them to, make it through whatever they're going through, which is tariffs today.
And I don't think this is anything like the COVID pandemic, where some businesses were doing zero revenues.
Right.
I think some of our businesses will be impacted. Possibly we go into a recession. We can talk about recession later and why we're not worried about that. Possibly companies will not meet their earnings guidance. I think that's a certainty as well. Mm-hmm. But that should not matter to the long term for many of these businesses. I'll just give you a specific example. So, just dialing down on Live Nation, going back to that example. During the pandemic, the share prices, I think the shares were about $60 a share heading into the pandemic. Stock fell to 20. No revenues for that business. No one's allowed to leave their house. No one's going to concerts. Live Nation was absolutely screwed at that time. The only concern was, are they going to be able to stay in business? And what's going to happen, with their business if we're never allowed to leave our houses? How are they going to adapt? Luckily, within a year or so, things had started to ease. They figured out they could do outdoor concerts. They figured things out. And lo and behold, the stock is now $120 a share. Got up to $150 a few months ago, but that was a different world. So stocks can and will recover. We all have very short memories. The stock market, extremely short memory, because there's lots of players in the market, people betting on what's going to happen in one day, 1 week, 1 month. We're the long-term guys, so sometimes we're kind of in a fog here and at the mercy of the short-term traders, but they're playing a completely different game than us. So we don't want to be suckered in to what short-term investors are doing or algos are doing. Our game, it's not a game, of course, but our approach, our strategy is totally different than that. We should be using any pullbacks as opportunities to buy better names, to add to more positions. and as long as our companies are going to come out of this stronger, and at some point some things will change, there's absolutely no reason for us to make any selling decisions. We do not sell in a declining market. We do not let the market dictate what price we're going to sell our shares at. We don't have to. Someone knocks on your door and says, "I want to buy your house," and the price stinks. You can just tell them where to go. And that's the same thing with your portfolio. You don't own flashing numbers on a screen. You own shares of really good businesses. And I think I've beaten this horse to death, unless you have any more. I just want to say one final thing is what are the catalysts? How do you get out of this? No one knows, right? You don't know what's going to happen. You don't know where it's going to end. Will there be negotiations? I don't know. Will the whole world change and the U.S. will become a manufacturing giant and Trump will get his way? Maybe. Will that be bullish? Maybe. We don't know. We just don't know how that's going to play out. But what we do know is, making moves, short-term moves based upon really having no knowledge of what's going to happen next in the short term could be extremely detrimental to your portfolio. So we're not going to change our course in short stocks or try and figure out which stocks will do better in this short-term environment. That's just not how we do things. It's not what we do. Obviously, if you're feeling nervous, if you want to talk to us, please reach out. We'll explain to you all this and in detail about what we're doing, what we're thinking, and make changes that are appropriate for your risk tolerance, of course.
I think one thing I would add to the portfolio management comment is one last thing that we don't do is we don't borrow on margin to buy stocks. I think a lot of the selling that you've seen in the last week, especially, and it has made the whole sell-off worse, is people buying stock on margin.
Yeah.
And as a result, being forced to unwind trades and sell even high quality businesses that have absolutely nothing to do with tariffs because of margin calls, right? And so that's something that we never do. We think there's no reason to do it in a portfolio when you're owning good companies already, and that's something that I think investors should be really careful of.
So in the next few days, weeks, months, we'll probably get data points that are not as good as the data points we've gotten in the past few months. Certainly, I don't know, but it's probably looking that way. You might be wondering, so shouldn't we do something before things get worse, before a recession hits? The problem with that thinking is we might already be priced into the market. B, of course, the news doesn't have to get better for stock prices to recover. Just the news has to stop getting worse. Perfect examples, of course, is the great financial crisis. People were still defaulting on their houses left and right, losing jobs left and right in 2010 and 2011, yet the market was recovering. 2020, of course, so sorry to hear all the people getting infected with COVID, people dying, more strict regulations and rules, yet the stock market started to recover. So you never know what the policy changes are going to be, the monetary changes are going to be, the knock-on effects, the offsets.
It's in 22 as well.
In 22, yeah. There were rallies in 2022, but that was, how did we get out of the 2022? Well, the data was still bad. It wasn't like inflation was so great. It just was getting less worse, right? Instead of a 9% CPI, we got an 8% CPI. And so the markets could see their way out of it. So that's what we're hoping for. I think since the beginning of time, there's been 27 bear markets, 28 recoveries.
Right. And I think a lot of people would say that this time is different.
Everybody says that.
So the reason that people say it's different is because this time it is entirely self-inflicted, right?
Even a pandemic was self-inflicted.
Sure,
everything is self-inflicted. The financial crisis, Americans lost their brains and bought 12 houses, and
right.
So it wasn't like it was nobody's fault.
Okay.
Yeah.
No, but that's the point that I wanted to make is that
it can be reversed.
It doesn't matter in practice,
yeah.
Like whether it's self-inflicted or doesn't or not, right? Like I think ultimately the way that it plays out is that you don't want to sell stocks when everybody else is worried about stocks being down. And I think like the history of the stock market would suggest that eventually this figures itself out in some way, in some fashion, and that things are probably going to be all right.
Things are probably going to be all right is our motto. So thank you for that, Ernest, on
Things
that
are
part of the
probably going to be all right.
Yes, I think they're going to be all right. And if history's any guide, I don't think the U.S. administration is out to cause a Great Depression. So I'm hopeful cooler heads will prevail in the coming days and weeks. Let's talk quickly about diversification, and we also wanted to cover.
Well, I think this is all related topic. So, I think a lot of people, a general conventional portfolio theory says that the way that you diversify your portfolio to protect yourself from, the exact situation that we're having right now is that you'll have your asset allocation. You might have let's say 20% S&P 500, let's say maybe 15% Canada, maybe 20% international developed markets outside of North America, maybe 5% gold, and then the rest fixed income, and with some in developed markets, some in emerging markets, and so on, right? So your portfolio is kind of covering the broad spectrum of investments across the world.
Okay.
And the reasoning for this portfolio is that you're diversified, so that, so let's say the US is bad, then you have the rest of the world and your fixed income and your gold and your to provide a buffer, because it's not perfectly correlated. So you're not going to lose as much as if you were all in the S&P 500. So the problem with this portfolio, as we're seeing, the problem with this logic as we're seeing right now, is that you have no idea what the correlation between all the different markets is. We actually saw this in 2020 as well.
Yeah.
Right. Stock markets, for whatever reason, I have no idea why, they've become more correlated. So if you own 100% S&P 500 this year, you're down, I don't know, 10% or so.
A little more, but
more than that. But Europe's down almost as much. China's down as much. Yeah. Japan's down as much.
They were holding in better until recently.
Right.
Yeah.
TSX is, I think, doing a little better because they have some gold, but you're not doing well still.
No.
So that's why we focus on owning the companies within, and we've talked about this on previous podcasts, where that's why we focus on the individual companies that we own rather than the geography of the exchange that the company just happens to sit on. Apple is a very diversified company. If you really look at it, right? They actually, more than half of their revenue comes from outside of the US. So if we're talking about a diversification in terms of actually where the revenues are being earned, Apple is almost is more diverse than the index that you are looking at.
Correct.
And if we look even beyond that, when we're constructing the portfolios of the companies, what we try to avoid is companies that are correlated in their end market exposures. So if you own, as a silly example, if you own 10 oil companies in your portfolio, right? You're diversified by your name, but there's zero diversification, because in the end of the day, if the price of oil goes up or down, your portfolio is going to go up or down. And so that's why we try really hard to look at what markets the companies are selling into, and then trying to have exposure to industry leaders in a wide range of markets that have really nothing to do with each other, right? So we own Costco. They're a general retailer, kind of, more tied to consumer spending. We have Domino's Pizza. Pizza has nothing really to do with iPhone sales, right? We own Moody's, they're tied to credit ratings, right?
I mean, one thing that all these companies do have in common, of course, is if a recession hits, if bad times occur, companies are going to suffer, and
Yeah.
and that's why stocks are down. The market is starting to price in recession. The market is as Buffett says, it's a voting machine, and people are voting with their feet in the sense of there are tough times ahead, and I don't want to stick around for that recession. And then I'll come back when the recession is over. The problem is when you come back, then the recession is over, you'll be buying those stocks at much higher prices than you sold them at.
Right. And to us, I think that's really what diversification is. It's owning a range of companies in different industries that are not really that are not impacted by the same economic factors.
Yeah.
And so that's one thing I would want to kind of throw out there in terms of how we deal with this issue.
Excellent. So that's really our take on what's going on in the markets today. We'll see over the next few days and weeks. We'll see a lot of volatility. All right. It's not going to be fun. It's not going to be pretty. We don't have the short-term answers. I don't think anybody does. Anybody that tells you that they do is completely lying because no one's going to be able to figure out what the next step ahead is. And of course, the offsets. There's a lot of variables at play in this market. We're going to do our best, of course, to make sure that you're insulated from these losses. One of the things we don't want to do is trigger losses and start blowing up our portfolio. In the pandemic, if you would have sold all the airlines and the hotels and the cruise ships, and the Live Nations, that would have worked for a bit, and then it doesn't work. And then what you're doing is, if you wanted to get back into them, you're never going to catch the bottom, and you're probably going to be buying them at a higher price. So the journey to investing is filled with a lot of potholes, a lot of speed bumps, a lot of roller coasters, but the destination for everyone, if you own good companies, should be very, very enjoyable. Anything else you want to add that we didn't cover in this market meltdown edition?
I don't like talking about this stuff.
No, we don't.
I prefer it when we used to do like deep dives about when like a new company that we're studying and how they're trying to gain market share.
Yeah, and we're going to get back. We're going to get back to that. I think this is one just so we can talk to our clients, those especially that are new and haven't been with us for a long time, to get a sense of how we operate. A lot of our long-term clients will call, but they know exactly what we're going to tell them, and they've lived through multiple downdrafts, and they've lived through our approach. If you're looking for action, our approach may not be the one that's absolutely right for you, but it's the only one we know how to follow. Talking about the macro is something that Ernest and I really try to ignore. I mean, they're talking points, but I don't think they're at all helpful for your portfolio, right? We're one tweet away from the stock market recovering or going down again, right? That's not, how can you even play that out?
No, I can go on a big rant about macro forecasting.
Yeah. So macro, we're not going to do that. It's so much easier and so much, it's an easier life to just focus on owning great businesses and seeing if they can adapt as the environment changes, instead of thinking what gold is going to do next, what interest rates are going to do next, what currency is going to do next, and trying to hedge that or get in or out of those things. Inevitably, we're going to cause so much more damage than if we sat here and just said we know we own good businesses. In the meantime, Ernest, what are you looking at? It's business as usual, right?
Okay.
Yeah.
No, so one last point on the macro,
Yeah.
which is that I think it's very easy to say clever sounding like things in macroeconomics that actually have absolutely nothing to do with investing.
Okay.
And so, for example, right, there's a lot of people these days talking about how the post-war global economic order is finished.
I don't even know what that means.
Exactly. Like, what does that even mean?
I have
right?
no
like,
idea.
So, does that mean that people aren't going to buy pizza or buy Nikes anymore? I really don't know what that means from an investing perspective. So, and even to the extent that let's say you were right. Okay, so the economic order's done, right? So does that then what?
Yeah.
Right? Like, should we all just like what do you want us to do with our money? Like, if the US dollar is not a reserve currency anymore, like, what should we own? Canadian dollars? Like,
No, I don't know. You should own cans of tuna and can openers. But in all seriousness, I think you're raising the right point about the macro. It's just impossible to know. And yes, saying that everything's going to be okay and you own good businesses doesn't sound as tangible as let's take action on this. And of course, you're going to get confirmation bias in a bear market or in a downturn because it's going to be choppy. And you're going to look at your portfolio. It's down Monday. It's down Tuesday. It's down Wednesday. Oh my God, I know it's going to keep going down. Should I call Barry? Should I call Ernest? Should I call David Baskin and have them make changes to my portfolio? The answer is you shouldn't, but please call us to discuss anything. So Ernest, what do you do?
Okay.
As a you don't talk to clients as much as I do. What does an analyst do during a market pullback?
So I think what's really good about these times is that because everything is down, there's a lot of high quality businesses out there that are available at more attractive prices than they normally would be. Mm-hmm. And so that's really what I'm spending most of my time doing today. It's looking at businesses that we've previously looked at and maybe thought were too expensive, kind of reevaluating, do we still like it as much in a world if, let's say economic growth is a little bit lower because of tariffs or whatever? And do we like this name more than something else that we also have in our portfolio today? Mm-hmm. Because, don't forget, because unfortunately the stocks are down, so there's less capital gains tax to pay. So the friction to swapping names and upgrading your portfolio is better. Yeah. And so that's really what I've been doing. I've been looking at. I don't want to give any names.
No, we're not going to give any names, but we've been looking at.
But there are some good businesses that are available at more attractive prices than they have probably for the last 3 years, I want to say.
But I want to make the point to our clients that our process is research intensive. We're methodical. We take our time getting comfortable with the business before we purchase it. We don't want to make any fast moves in this market or, cost ourselves even more problems, like us, selling a Facebook at $200 thinking we're smart and watching it go back up to $600 a year later, right? Because we were scared about the declining price or, some kind of macro events. We just can't do that. So we're going to research them intensively. There may be some trades. There may not be some trades. I think we're supremely confident in all the businesses we own. It's just right now it's a terrible time for markets and a terrible time, good bad times can bring good times in the future, and we've seen that time and again with our portfolios. The recovery from 2020, the recovery from 2022, the recovery from 2008. From the 2008 financial crisis, the stock market from 2009 to 2024 pretty much went straight up, except for some meaningful pullbacks. So maybe the world order has changed. I don't know. Who wrote that? Ray Dalio?
Yes.
Yeah. Yeah. I try not to spend any time thinking about that. This is like galaxy brain 8D chess. That is a complete waste of time, in our opinion.
Yeah.
Sound good? So watch out for the possible some trades in your portfolio or not. As always, we would love to answer any of your questions. If you want to come in and talk with us, speak to your portfolio manager. We are experts at making people feel better when markets are very bad. And we have lots of experience with bad markets, and we know the right things to do. So with that, I will bid you adieu, and we'll see you back here next week. And hopefully next week we'll focus more on what Ernest loves, which is talking about companies and less about theoretical macro. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management, and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.